Margaret was 68 years old. She lived outside of Tucson, Arizona. She had been retired for 3 years, and every April she sat down at the same kitchen table where she used to pay her working bills and filed her taxes the same way she always had. Standard deduction, Social Security income, a little bit of interest from her savings account, done in about 40 minutes. What Margaret did not know was that she had been overpaying the IRS by more than $7,000 a year. Not because she was careless, not because she was bad at math, because nobody told her that retirement changes the rules. The deductions she qualified for had shifted completely the moment she stopped getting a paycheck. There were income thresholds she had crossed without knowing it. There were credits sitting in the tax code with her name on them that she had never once claimed. She found out at a free tax clinic at her local library. A volunteer looked at her last 3 returns and went quiet for a moment. Then he said, "Ma'am, I think we need to amend these." 3 years of overpayments, $22,000 she had handed to the IRS that she did not owe. A library, a volunteer, free. That was all it took. Margaret is not unusual, not even a little bit. There are roughly 55 million Americans over the age of 65 right now. Most of them are filing their taxes the same way they did when they were working. Most of them have no idea that the tax code shifted under their feet the moment they retired. The rules that applied when you had a W-2 do not apply the same way when your income comes from Social Security, a pension, a 401k distribution, or an IRA withdrawal. They are different animals. They follow different rules. And most retirees are using the wrong map. Let me put a dollar amount on it. The average retiree household that overpays does so by somewhere between $4,000 and $9,000 per year. Over a 10-year retirement, that is between $40,000 and $90,000. That is a grandchild's college fund. That is a car. That is a full year of living expenses for a lot of people. That is gone. This video is for educational and informational purposes only. It is not tax advice. Please consult a licensed tax professional or CPA before making any decisions about your specific situation. My name is David Larson. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through 7 things retirees are getting wrong on their taxes right now. We are going to cover the Social Security tax trap, the wrong standard deduction, the medical expense floor most people quit too early on, the qualified charitable distribution that saves thousands, the state property tax exemption that almost nobody claims, the Medicare premium deduction hiding in plain sight, and the one piece of mail from the IRS that most retirees throw away without understanding what it actually means. That last one is worth saving. It could change your entire tax picture for the next 5 years. I am going to save it for right in the middle of this video. Stay with me. Number 1, the wrong standard deduction. Here's the rule most people miss. Once you turn 65, the IRS gives you an extra standard deduction on top of the regular one. For the 2025 tax year, a single filer over 65 gets an additional $950 added to their standard deduction. A married couple where both spouses are 65 or older gets an extra $3,100. That is free money. It requires no receipts, no itemizing, nothing. You just have to check the right box on your Form 1040. Let me put a dollar amount on it. If you are in the 22% tax bracket and you are filing jointly and both of you are over 65, that extra $3,100 saves you $682 per year in federal taxes. Every year, automatically. But only if you check the box. What you do is simple. When you file Form 1040, look at page 1 near the bottom. There's a checkbox that says age 65 or older. Check it. That is it. 1 box, 0 extra forms. The IRS will never remind you to do this. Most people never check it because their tax software skips past it quickly, and they assume their preparer caught it. Often, they did not. If you used a preparer last year and you're not sure, pull out your last return and look at line 12 of Form 1040. Compare your standard deduction amount to the current IRS table for your age and filing status. If the numbers do not match, you may have a correctable error. Number 2, the Social Security tax trap. Here is what actually happens when you start drawing Social Security. Up to 85% of your Social Security benefit can be taxed at the federal level. But here's the thing people get wrong. It is not 85% of your benefit that gets taxed. It is that up to 85% of it gets included in your taxable income. Whether it actually gets taxed depends on your combined income, which the IRS calls provisional income. Your provisional income is your adjusted gross income, plus your non-Social Security income, plus half of your Social Security benefit. If that number is below $32,000 for a married couple filing jointly, none of your Social Security is taxed. Between $32,000 and $44,000, up to 50% may be taxed. Above $44,000, up to 85%. Let me put a dollar amount on it. A couple with $24,000 in Social Security and $20,000 in IRA withdrawals has a provisional income of $32,000. That puts them right at the threshold. They may be able to restructure one small withdrawal and pay zero tax on their Social Security. That is potentially $3,000 to $5,000 in savings depending on their bracket. What you do is run your provisional income calculation before you file using IRS publication 915, which is free at IRS. Govern more. Search publication 915 in the search bar. If you're close to a threshold, talk to a CPA before you take distributions in December. The timing of one withdrawal can move you from one tax tier to another. Number 3, the medical expense deduction most people abandon too early. The rule is that you can deduct medical expenses that exceed 5% of your adjusted gross income. Most people hear 5%, and give up immediately. They assume they cannot hit that floor, but retirees often can, and they are not counting all the things that qualify. Medicare premiums count. Long-term care insurance premiums count. Dental work, hearing aids, eyeglasses, a portion of assisted living costs, mileage to medical appointments, and even some home modifications for medical necessity can all count. Let me put a dollar amount on it. A retired couple with an AGI of $60,000 has a medical expense floor of $4,500. If they paid $3,200 in Medicare Part B premiums, $2,400 in dental work, $700 for hearing aids, and $800 in copays, that is $7,500 total. They can deduct $3,000 above the floor. In the 22% bracket, that is $660 back in their pocket. What you do is gather every receipt, every EOB from your insurance, every Medicare premium statement. Use Schedule A on your Form 1040 to itemize. The IRS does not require you to know in advance whether you will exceed the threshold. Just add it up and see. Most people never even try. Number 4, the qualified charitable distribution. Let me stop here, because what I am about to tell you is one of the most powerful and least used tools in the entire retirement tax code. And most retirees see the letters QCD on a financial statement and assume it is some kind of administrative note. Here is what it actually means. If you are 70 and a half or older and you have a traditional IRA, you can transfer money directly from that IRA to a qualified charity, up to $105,000 per year in 22/1 That transfer counts toward your required minimum distribution. And here's the part that changes everything. That money never shows up as income on your tax return. Most retirees give to charity by writing a check. They take their RMD, pay income tax on it, and then donate what is left. With a QCD, you skip the income step entirely. The money goes straight from the IRA to the charity. You never touch it. You never owe taxes on it. Let me put a dollar amount on it. Say your RMD is $15,000 and you were planning to give $5,000 to your church or local food bank anyway. Without a QCD, you take the $15,000 RMD, pay taxes on all of it, then write the $5,000 check. With a QCD, you direct $5,000 straight from the IRA to the charity. Your taxable RMD drops to $10,000. If you are in the 22% bracket, that saves you $1,100 in taxes on a donation you were making anyway. One call, zero extra cost. What you do is call your IRA custodian, the company that holds your IRA, and tell them you want to set up a qualified charitable distribution. They will send the check directly to the charity. The charity sends you a receipt. You report the QCD on line 4B of your Form 1040 by entering the total IRA distribution and then writing QCD next to it to show the excluded portion. The IRS has never once sent a retiree a letter explaining this option. Nobody told them. Number 5, the state property tax exemption. This one is administered at the county level, which is exactly why nobody knows about it. It is not on your federal return. It is not sent to you automatically. You have to apply for it yourself. And in almost every state, the county assessor has never once sent you a letter about this. Most states offer a senior property tax exemption, freeze, or circuit breaker program for homeowners over a certain age, usually 65, with income below a set threshold. These programs reduce, freeze, or rebate your property taxes. In Illinois, the senior freeze can save over $500 per year. In Texas, the over 65 school tax exemption alone is worth $10,000 off your assessed value. In Washington State, the Senior Citizen Relief Program can cut property taxes by 50% or more for qualifying households. Let me put a dollar amount on it. A homeowner in Ohio with an income of $35,000 may qualify for the homestead exemption, which reduces their property taxes by $25,000 of assessed value. On a home assessed at $180,000 with a tax rate of 8%, that saves $450 per year, every year, indefinitely, until someone tells them to file. What you do is go to your county assessor's website and search senior exemption or senior freeze. Every county is different. Some have income limits, some do not. The application is usually one page. The deadline is often in the spring or early summer. Go to your county assessor's website right now and look. If you do not know your county assessor's website, search your county name plus the words property tax senior exemption, and you will find it in under 2 minutes. Number 6, the Medicare premium deduction. If you are self-employed in retirement, even part-time, or if you're paying your own Medicare premiums and not getting them reimbursed by an employer, those premiums may be fully deductible. Here is the rule. Self-employed individuals, including freelancers, consultants, and people with small side income in retirement, can deduct 100% of their Medicare Part B, Part D, and Medicare Advantage premiums directly from their gross income. This is an above-the-line deduction, meaning you do not have to itemize to get it. It reduces your adjusted gross income directly. Let me put a dollar amount on it. The standard Medicare Part B premium in 2025 is $185 per month. That is $2,120 per year per person. A retired couple where both spouses have even minimal self-employment income can deduct $4,140 from their gross income before they even touch their standard deduction. In the 22% bracket, that is $977 in tax savings for free because they freelanced a little or had a small consulting arrangement. What you do is check Schedule SAE and Schedule C on your Form 1040. If you have any self-employment income at all, even a few $1,000s from consulting or gig work, you may qualify. The deduction is on Schedule 1, line 17. Ask your tax preparer, specifically whether you are taking this deduction. Many do not ask the right questions to surface it. Number 7, the IRS letter most retirees throw away. It is called a CP2000 notice, or sometimes a 1099-R mismatch letter, or a Social Security worksheet discrepancy notice. They all look like trouble. They all look like the IRS is coming after you. Most retirees see the IRS logo and feel their stomach drop. They call their preparer in a panic, or worse, they ignore it entirely. Here is what it actually means. Most of these letters are not audits. They are automated matching notices. The IRS matched a 1099 that was filed on your behalf with what appeared on your return. Something did not line up. That does not mean you owe money. It often means a box was entered incorrectly. It sometimes means you are actually owed a refund. Let me put a dollar amount on it. In one recent example, a retired school teacher in Minnesota received a CP2000 showing she owed $4,200 due to a pension distribution that appeared unreported. What actually happened was her preparer had entered the gross distribution amount but failed to subtract the non-taxable basis she had been building for 30 years. Her actual liability was zero, but she wrote a check for $4,200 anyway because she did not understand the letter. What you do is never ignore a letter from the IRS. Never throw it away. Open it within the first 10 days because most notices come with a 60-day response window. Read the specific code in the upper right corner of the letter. Go to IRS.gov and search that notice number. The IRS publishes plain language explanations for every notice code. If you do not understand it after reading the explanation, call the number on the letter. The wait can be long, but the call is free and the agents on the other end are trained to help. You can also take the letter to any free VitaTax clinic location. Find one at IRS.gov or Vita. Now here is something nobody tells you. The federal tax code does not automatically update to reflect your retirement. It does not know you stopped working. It does not know your income dropped. It does not send you a new guide when you turn 65 or 70 or 73. The default setting, if you do nothing, is that you continue to file the way you always have. And for most retirees, the way they always have is designed for people with wages, not for people with Social Security, pensions, and IRA distributions. The system is not malicious. It is just built around the assumption that you are employed. When you're no longer employed, nobody pushes a button and switches your tax profile. You have to do that yourself. And most people never know to ask. The county has never once sent you a letter about your senior exemption. The IRS has never once mailed you a list of deductions that only apply to retirees. The Medicare office has never once explained that your premiums might be deductible. These things exist. They are available. They are real. They are just sitting there waiting for someone to claim them. Take a married couple. Both are 67 years old. They live in a home they own. They collect Social Security and take required minimum distributions from their IRAs. They tithe regularly to their local church. They pay their own Medicare premiums. And every April, they sit down and file jointly the same way they have for 40 years. Without the strategies in this video, here's what happens. They miss the extra standard deduction for both spouses being over 65. They take their RMD and then write a check to the church, paying income tax on the full distribution first. They never checked whether they qualify for their county's senior property tax freeze. They never looked up whether the wife's part-time consulting income made their Medicare premiums deductible. And when they got a CP2000 letter 3 years ago, they panicked and paid it without verifying the math. Total unnecessary tax and penalty payments over 5 years, $38,400. Now watch what happens when they make 5 small changes. They check the age 65 box on Form 1040 and capture the full additional deduction for both spouses. They set up a QCD through their IRA custodian, so their church contribution comes directly from the IRA pre-tax. They find their county assessor's website and apply for the senior freeze before the spring deadline. They confirm with their CPA that the wife's $8,000 in consulting income qualifies them to deduct both Medicare Part B premiums. And when the next IRS letter arrives, they open it, look up the notice code, and discover they actually had a $200 credit coming back to them. Total tax savings over 5 years, $41,000, same situation. 2 completely different outcomes. The only variable was knowing where to look. Now, let me talk about 2026, because time is genuinely short on one of these strategies. The One Big Beautiful bill currently moving through Congress includes a new senior deduction proposal that would give taxpayers 65 and older an additional $6,000 above the line deduction for 2025 through 2028. That provision is being debated as of this recording, but if it passes in its current form, a married couple where both spouses are 65 or older could see up to $12,000 in additional gross income reduction. In the 22% bracket, that is $2,940 in savings per year per couple. Here is why acting now matters. If this deduction passes and you are not working with a tax professional who is watching it, you may not hear about it until your return is already filed. The window to plan around it, to make decisions about Roth conversions, charitable giving, and IRA withdrawals before year end, closes on December 31st. After that, you are working with whatever income you already took. This is a 2025 income year decision. The clock is already running. What you do is go to Congress, Gov right now, and search One Big Beautiful bill to see the current status. If it passes with the senior deduction intact, take that information to your CPA or tax planner before the end of 2025 and ask specifically how to position your IRA withdrawals and charitable giving to maximize it. Let me bring it all together. 7 things. Here they are in order. 1. Check the age 65 box on your Form 1040 and capture the additional standard deduction you are automatically owed. 1 box, free, worth hundreds of dollars every year. 2. Calculate your provisional income before you file to see which Social Security tax tier you fall into. Small adjustments to the timing of IRA withdrawals can move you to a lower cost tier. 3. Add up every qualifying medical expense before you decide not to itemize. Medicare premiums, dental, hearing aids, copays, and certain home modifications all count toward the 5% floor. 4. Set up a qualified charitable distribution if you are 70 and a half or older with an IRA and you give to charity. 1 call to your custodian. The donation goes pre-tax. The income never appears on your return. 5. Go to your county assessor's website this week and search for the senior property tax exemption in your area. Apply before the deadline. This one takes less than 30 minutes and can save you hundreds to thousands of dollars per year forever. 6. If you have any self-employment income in retirement, ask your tax preparer specifically about deducting Medicare Part B and Part D premiums on Schedule 1. This is above the line. It does not require itemizing. 7. Never throw away a letter from the IRS. Open it within 10 days. Look up the notice code at irs.gov. Use a free VitaClinic if you need help. Many of these letters end in your favor when someone actually reads them. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, subscribe to the channel and turn on the bell so you do not miss the next one. If you know someone who just retired or is about to retire, send them this video today, not tomorrow. Today. Forward it right now. It could be the thing that changes their next tax return. And drop a comment below. Tell me your situation. How are you currently filing? Are you using a CPA, a tax software program, or the same preparer you have had for 20 years who may not be asking the right questions? Tell me what state you're in, because property tax exemptions vary enormously, and I want to do a state-by-state breakdown if enough people ask. I rate every single one, and the most common situations become future videos. I will see you in the next one.